A scary fact is that most investors lose money when they start investing. And according to eToro, 80% of day traders lose money within their first year. Now, how is this possible and what can we do to change this? Well, a lot of new investors, they just jump in the market. They might have heard about a stock that is doing well from a friend or family member, a hot stock. So they just jump in and start investing in that stock without doing any type of research. Another reason is also during this situation that we're in with the pandemic, there are a lot of people that are pretty much bored to death and they're sitting at home trying to figure out what they want to do next in life, and they decide to jump in and play the stock market game. So for example, in the US, Robinhood is really popular. So Robinhood attracts a lot of new investors because the app, if you use it on your phone, you can also use it on your desktop. But if you use Robinhood on your phone, it's really user-friendly. It's like playing a video game. And buying and selling of shares on Robinhood is extremely easy. What's also interesting is that whenever the stock market is doing extremely well, so we're constantly seeing new highs, people jump in, invest, and they see their capital gains, and they automatically think that they know how the stock market works, what's the best stock to buy, what's the best stock to sell, and they think that they're an expert. There are also a lot of investors that like to invest in companies that they know of, so such as a company like Facebook, maybe even Tesla, without even doing additional research on how profitable this company is, how much revenue this company is generating, how much debt does the company actually have. So that's why if you're a new investor, a good thing that you can always do is to start doing some research on the companies that you're investing in. Now, in order to do some research, there are a ton of books on investing out there. And that's also how I started. Before I jumped in and I started investing on all these different index funds, mutual funds, and even individual stocks, I read a bunch of books first just to get acclimated with how the stock market actually works. You don't have to read books because there's a lot of information available even on YouTube, and there's a lot of information available on the stock market on the web. But reading this in a book makes it easier for you to focus on that specific topic. So there are no distractions. There is nothing popping up on your phone or on your desktop. You don't have a new tab open for Facebook. So when you sit down and when you read a book, you can take notes and you can focus a lot better. So if you think about the stock market, there's pretty much two ways of making money: fast or the long-term approach. Now, if you want to make money on the stock market fast, you have to think about the risk you are willing to take, because fast money usually equals a higher amount of risk. So a bigger chance that you can lose some or all of your money. Now, the long-term approach of making money in the stock market is going to be a lot more safe, of course, less risky, but it is a slower process. So it might take 10 years or even more in order to hit your goal. Now, for tip number 2 is to study the greats. There are investors that have been investing for decades and they have a track record of all their wins. Now, as an investor, you're always gonna have some losses. But as long as your wins overshadow your losses, you will come out on top. Now, some of these investors that you can follow and even read books on, some of these you might already know, but you got Warren Buffett, Ray Dalio, Charlie Munger. Of course, there's more, but starting out with those 3, that gives you a good example of who can I follow. Let me see what they did in the past and how have they changed their investing strategy style in order to build all their wealth. There are many articles written on these guys and there's also books on them, so it's easy to find out information on their thought process when it comes to investing. And even before you do some research on these guys, you might be thinking that, yeah, but these guys had money. They had a lot of money when they started out investing. That's not necessarily true. Even if you look at Warren Buffett, he did his due diligence by, even at a young age, he went to his local library and he read all the books in the library on stock market investing and the stock market in general. He's also been somebody who was always fascinated by numbers, which helps when you analyze these companies on the stock market. and he had an entrepreneurial spirit even at a young age. And early on, Warren Buffett, his mentor or the person that he looked up to was his teacher, Benjamin Graham. But later on in life, he did tweak his investing style somewhat and made it his own. And I like the way Warren Buffett invests. That's also my investing style. He's a value investor, so he's a buy and hold investor. He likes to buy companies at a discount and hold on to them until they are not profitable anymore, or he sees that they're heading in the wrong direction, and that's when he sells them. But of course, even if you are somebody who does not want to be a value investor, you want to be a day trader, there are a ton of good day traders out there that you can do research on, but make sure that you don't get scammed when it comes to day trading, because there are a ton of scams when it comes to day trading, cryptocurrency, forex trading, and the list goes on and on. Now, tip number 3 is to write down your goals. If you write down your investing goals, it will automatically push you in a specific direction on what type of investor you have to be. So let's say you have a goal of building your investment portfolio up to $1 million by retirement age, and you're in your early 30s or late 20s. You can take the long-term approach of building your wealth because you have all this time on your hands. So you can do research on individual stocks that you want to add to your investment portfolio, bonds, index funds, or even mutual funds. Now, on the other hand, let's say you wrote down a goal and you want to make 10, 20, or even 50K within a year or two. Then you have to look at some of the ways that people have been making money fast on the stock market. Now, making money fast usually equals a higher amount of risk and also a bigger chance that you can lose some or all of your money. So definitely pay attention to how risky you are and how much money you are willing to lose in order to get that gain that you want. Now, some of those options might be, of course, day trading, forex trading, maybe even call options. But there are a ton of people that day trade out there that do give out good information. Just be sure that you're following somebody who's credible. Now, tip number 4. Once you've decided what type of investor you are, you do need to know about fundamental analysis versus technical analysis. So if you are a value investor, somebody who likes to look at individual companies in order to analyze those companies, then you need to know how to do fundamental analysis, which is pretty much you are analyzing the metrics of a company. So you look at the revenue, you look at the net income, how much debt a company has, the return on equity, the return on invested capital, and more. Somebody who's a value investor is somebody who likes to analyze these metrics in order to decide if this is a company that they want to invest in based on how profitable this company will be for them. Now, on the other side of the coin, you have technical analysis. Now, technical analysis is used by day traders, swing traders, and even scalpers. When it comes to technical analysis, traders like to look at stock charts. They like to look at intraday charts. They like to look at candlesticks. They look at these charts in order to spot trends and even patterns by applying some indicators also in order to decide when to buy or sell for a profit, of course. Now, a good trading platform to use if you're a day trader, and I also have access to this trading platform, is the Think or Swim platform by TD Ameritrade. Now, a lot of day traders like using this platform because it's robust, it's user-friendly, and it has all the indicators that you need in order to day trade successfully. Now, when it comes to getting the knowledge for fundamental analysis versus technical analysis, when it comes to fundamental analysis, I like to read books in order to get that knowledge. And even if you check out my channel, check out my audiobooks, I do have audiobooks on fundamental analysis. Now, when it comes to technical analysis, however, I don't like to read about technical analysis in a book. I'd rather see it in a video format. So somebody explaining to me what a chart pattern looks like, why they made a specific trade, and at what specific point. So video format, somebody explaining it, even in a live feed, that's a lot better to learn how somebody is doing day trading using technical analysis. So tip number 5, never fall in love with any of the companies that you own stock in. Now, this is a lot easier to do for day traders or swing traders or even scalpers because they could care less about the companies that they trade because they just buy and sell for a profit real quick. But if you are a value investor, pay attention to your emotional state when it comes to buying these companies, because if these companies don't perform the way they should, you need to pull the trigger and sell them. I even remember when I first started out investing and I started buying stocks in companies that I grew up with, such as McDonald's, Nike, Coca-Cola. I felt proud of myself. I'm like, okay, these are actually companies that sell products that I use on a daily basis, and now I own a piece of those companies. So that made me feel real good. But then one thing that I noticed is that if the company is not performing too well, why even hold on to that specific company? So as a value investor, always do your due diligence by analyzing the companies that you're investing in using fundamental analysis. And if they don't check out as a good company to invest in, don't buy them, or if they're not performing, sell them, even if it's a company that you grew up with and you're still using their products. Some pushback that I sometimes get when I tell this same thing to my friends and family members is that they say to me that, okay, the company might not do too well right now, but I believe in the company. The company will pick back up and it will be a company to hold for the long term. Well, to that I always say that I cannot look into the future, so I don't know how well the company will perform in the future. What I do know is that currently the company is not performing, so why keep my money in a company that's not performing well for me when there are a ton of companies that are performing well that I can easily invest in, which will allow me to sleep well at night. And tip number 6, just have fun with investing. When you think about investing, even if you're a new person who jumps into the stock market, it's stressful. You have a lot on your plate because if you're new, you look at all the different options that you have. Index funds, mutual funds, ETFs, bonds, individual companies that you can invest in. There is a plethora of information out there also. So it's easy to get lost in all of this. But just make sure that you have fun. Just start out small. Even if you want to test and experiment with different investing styles, just go for it. Take just a small amount of money and start out investing. Now, investing can be stressful also, even if you are somebody who is a long-term investor, because you might look at your investment account and you see that Monday you're up 10% and then the following day the stock market just crashed. Just keep in mind that the stock market has crashed many times before in the past, but it's always been able to bounce back. And with tip number 6, just have fun. Just keep in mind that the stock market will not forever go in an upward trend. There is going to be turbulence. Things are going to happen, even when it comes to individual companies that you might be investing in, or even on an economic scale, which will definitely have an impact on the stock market. Make sure that you know that things can happen and just enjoy the whole process. Don't look at a setback as, oh no, I need to sell everything. Just enjoy the good times and also try to enjoy and try to learn from some of the setbacks.